Welcome back. You're watching The Inside. The RBI says that the rate of inflation is way above its comfort level. So why is it that despite repeated rate hikes, inflation just won't come down? Nikhil Sivadas has the answers.
Up, up and away. That's how inflation has moved these past few months. And it's a cause of worry because this is the longest spell of high inflation since the mid-90s. And the worst is not past us. Not just yet. And that's the reason why the RBI has raised interest rates. Sure, it will hurt industry, but a little pain now will take the economy a long way. That is the driving force behind the RBI's recent rate hikes.
So a little bit of pain now, a little bit of medicine now, with the prospect of less suffering in the future, I think is the way to look at it. And that's why I want to emphasize that it is not a trade-off now between growth and inflation. It is a trade-off between inflation now and growth in the future.
That's because inflation has an adverse impact on the real economy and disproportionately burdens the poor. According to the RBI, low inflation is imperative for a welfare-oriented public policy. And high inflation leads to several distortions in the economy like distribution inequality and a diversion of resources from productive investments to speculative activities. It also reduces growth because of a fall in savings and investments and raises nominal interest rates because of a higher risk premia in financial transactions. Apart from that, it brings down external competitiveness because of an appreciation in the real exchange rate, thereby taking a toll on the overall growth of the economy. That's why the RBI prefers to err on the side of caution.
RBI has been following a good policy of, this has a way of correcting the international imbalances. The exchange rate has a way of correcting the imbalances as far as the Indian economy is concerned. I have a feeling that RBI is following a good policy of not interfering. But good policy. But the point is that RBI, once it goes beyond a point, obviously, we need to look at how we can, how we have to get it. But then the question remains still, it is RBI's domain in their sphere, and they know what the right action to take.
Indeed, picture this. Earlier this year, there was a spurt in food inflation as unseasonal rains in some parts of the country caused significant damage to output of vegetables. There has been a stronger than expected pass-through of increase in input costs to output prices. In the first half of the current year, the contribution of non-food inflation to overall increase in WPI has been significantly high. That's primarily because non-food inflation too touched a high of 8.5% in March this year and has remained at or above 7% since then. The RBI has raised rates 6 times since January, and even though liquidity conditions have tightened significantly, the inflation monster refuses to lie low.
The WPI in India is very much a lagged response to the rise in global commodities and fuel prices. Over the last 12 or 18 months we've seen rise in commodity indices globally, and the central bank in India has been very aware of and wanting to avoid a transmission of that pricing pressure into the local economy. So it's raised rates. Now, while the raising of rates has helped to ration credit and, if you like, slow down the money sort of credit side of the economy, inflation's continued to rise due to these global commodity pressures.
So on the one hand, supply side inflation is high as companies have passed on higher costs of production to consumers. And on the other hand, demand side factors are pushing up prices. Higher government spending on social sector schemes has raised disposable income, which in turn changed consumption patterns, particularly in rural India. Pulses, milk, eggs, fish and meat and fruits have been the major contributors to food inflation in recent months. Add to that the fact that agricultural productivity is falling, wastage is high, and infrastructure and supply chain management is poor. All of this ensures that many goods are in short supply. For instance, the daily per capita availability of food grains is lower than what it was in the mid-80s. But demand is higher because of greater affluence. and so there's too much money chasing too few goods.
Some of the increase in the prices of relatively superior food products like milk, eggs, meat and fish is partly attributable to rising income levels. This itself is a corollary of faster growth and the effectiveness of our programs of social inclusion, which have succeeded in putting relatively more income in the hands of the poorer sections of the community.
The other big factor contributing to inflation is the depreciation in the rupee, which has raised the price of import goods. The rupee is at a 28-month low and has fallen from 43.85 in July to 49.57. That's the reason why the RBI necessarily has to keep its sight trained on inflation.
The RBI had to resume tightening because the inflation turned out to be higher than what it was expecting. But they have at this point tightened aggressively, credit growth slowing, the economy slowing. They've had to keep tightening because there's been a lack of action on the fiscal side, so the RBI has to take all the pressure itself.
No doubt it's been a long and lonely battle against inflation for the RBI.
It becomes more difficult to deal with inflation using purely monetary tools if certain complementary measures are not undertaken, and we've highlighted some of these, essentially addressing issues of food supply, of overall the fact that the fiscal deficit is relatively large, and that is actually adding to demand.
But the battle needs to continue because the Indian economy is better off safe than sorry.
Most of these banks learned lessons during the Asian crisis, which, as you know, spread around the emerging markets world. So they don't have that much in foreign paper, U.S. treasuries, that sort of thing. They're more concentrated on the domestic market, and they built up stronger balance sheets.
Clearly, the Reserve Bank has done its bit to protect the Indian economy and help it get back on the right track. And now it's imperative that the government take a serious look at fiscal prudence and efficient policies. Experts say that if fiscal policies work in tandem with monetary policy measures, India may regain lost ground sooner than expected. Until that happens, the central bank will have to keep pulling the interest rate string to make sure that India's growth story is not just another hot air balloon.
But that's all we have for you in this edition of ET Inside. We'll be back next week, but until then, don't forget to write in with your feedback and suggestions. Thanks so much for watching.